2024 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. Yesterday, we got April started off to the beginning of the first quarter. Wasn't so great. Morning, we got off to a decent start, very open. But then we did come up with one of the manufacturing reports. It was actually the PMI manufacturing, and the actual number yesterday came in at 51.9. We have kind of turned the corner, though, with manufacturing. We're starting to show more expansion in the economy. And I think as a result, with inflation still in a lot of folks' minds, I think that certainly, maybe brought the Fed back into play. I think the Fed has kind of made their stand at this point, but we'll see what happens down the road. But I do think that the fact that manufacturers heating up is giving those who maybe think that interest rates could, maybe not be cut as soon as the Fed's predicting, maybe get pushed back later in the year, maybe even to 2025. I'm not in that camp. And of course, the market, a lot of times you see knee-jerk reactions. And so it could have been some of that as well. But anyway, we did see the market move lower. And let's take a look at that action from Monday. So we got the Dow Jones Industrial Average finishing down 240 points. That was down 3/5 or 6/10 of 1%. The S&P 500 lost 0.2 of 1%. That was about 10.5 points. Nasdaq actually did finish up, but it was up a lot more earlier in the day. The Nasdaq 100 finished up 38.5 points. That was just about 0.2 of 1% to the upside. But a couple of areas that have been strong of late, mid caps and small caps, both took it on the chin. Mid caps down 0.7 of 1%, and small caps down almost a full percentage point, down 0.94%. Transports down more than 1%. We had an opportunity to make a breakout yesterday. Didn't really do it, turned back around, went down. We finished down 1.11% yesterday. So across the board, even though we did finish up on the NASDAQ, we were down fairly significant from earlier in the day. Most of the selling did occur in the morning. And I do, I feel like if there's going to be manipulation, it's going to be in the morning. If I'm going to see lower prices and some selling, I'd rather see it in the morning than in the afternoon. And so that we did see more of. We saw more of the selling, the big push to the downside early in the day. And the 10-year Treasury yield early in the day took off to the upside. So that's kind of been, that's not normally what we expect long term. When we're looking, actually, I probably should think about this for a minute. How do I word this one? If you look at the equity prices, the S&P 500, NASDAQ, and so forth, since the 80s have been going up. And since the 80s, the 10-year Treasury yield has been going down. So it looks like there's an inverse correlation. But if you look using the correlation, if you're on a daily chart and you pull up the correlation and you just look at the more recent correlation, if you go back the last many, many years, you tend to have positive correlation between stock prices and the yield. So if the yield's going up, the tendency is for stock prices to go up. And the reason that is that when you're getting good news or something that would drive the stock market up, it generally is going to send folks out of the bond market and into stocks. And the folks coming out of the bond market, they're selling bonds. Bond prices go down, yields go up. Well, at the same time, that money is rotating into stocks, which sends stock prices up. So we normally have that positive correlation, even though the long term is opposite, and even though the short term right now is opposite. I think if you look back really the last year or two, as the Fed raises rates, that seems to, or as the yield, 10-year Treasury yield moving up, not so much the Fed raising. But when the yields are moving up, 10-year Treasury yields moving up, a lot of times we see that market pulling back. And that's not normal long term. The reason it's been like that in the last year or two is it's because the 10-year Treasury yield's been moving up as a result of inflation fears. That's not normally what we face when the yields are going up and down. Usually what's going on in the bond market relates to our economic cycle, where we are in the cycle, whether we're expanding whether the economy is contracting. Those types of things tend to, the 10-year Treasury yield kind of moves a little bit based on that. So I think the big problem with the market is that we're not quite yet past all the inflation talk, all the inflation fears, and a lot of market participants, honestly, don't have long-term memory. They have short-term memory. And so they believe whatever's been happening in the last 6 months or years is what's going to continue to happen. I don't think it's going to be like that. I think eventually the 10-year Treasury yield, I mean, on the one hand, I really don't mind the yield going up a little bit as long as we're stay below 5.25. Really, I mean, we set that high at 5, so I don't want to see it getting up much above 5. But as long as we're in the 4s, I'm fine with the 10-year Treasury yield. In fact, if the short-term rates come down and the 10-year Treasury yield moves up a little bit, that's going to be nirvana for banks. So I'm okay with that, but it's a new it's going to be something the market's going to have to adjust to over time, because that's not the way it's been working. But as we start focusing more on the economy and less on inflation, that's exactly how it's going to work. But in the meantime, in the short term, yesterday we saw a move back up into the 4. I think we finished 432, 433, close to breakout level. And this morning, the 10-year Treasury yield, right now it's at 440. So this is above where we saw. So we were in a short term, and I'll show you this chart in just a second, but we were in a short-term uptrend on the 10-year Treasury yield, effectively put in a cup, pulled back a little bit, and now we blasted through the cup. So this measures up to probably about 465, 470. So this could just be the start. And if that's the case, we might get that pullback that we talked about maybe throughout March. Now that we're into April, I was ready for the market to really go. But if rates break out and continue moving higher, that could be what keeps the market, somewhat settled at this point, down around the current range or maybe even a little bit lower. But we'll take a look at that 10-year Treasury yield in just a minute. Let's move on to the sectors. So yesterday, communication services had a nice day. Internet stocks have been picking up. Don't know if you've noticed it. Google really starting to show some strength, not only on an absolute chart, but finally starting to show relative strength. And the group overall is strong. And this group loves the month of April. So all of that combined, you want to keep an eye on it, on Google and the breakout that it had yesterday. We'll talk about Google later in the show. But anyway, communication services benefited from that, up 0.77% yesterday. Energy remaining on a roll. A lot of folks ask me, why don't you talk about energy more? Energy is the best area in the market. Hey, I agree. Look at the chart. I mean, that has been a straight up move. And what I have said about energy and what I'll continue to say is that short term, you can stick with that trend. If you're in energy, I don't see any reason why you would want to get out. It's overbought, but overbought can remain overbought for a while. The biggest problem I have with energy is that I don't think it's going to last. I think it's going to be a problem because the dollar is continuing to move higher. Well, if you look at a long-term chart, go back at least 15 years, and you'll see a clear uptrend in play on the U.S. dollar. When the dollar is rising, or when it's in an uptrend, energy and materials tend to underperform the S&P 500. You have pockets of strength from time to time. We've seen the crude oil prices moving up, and as a result, energy is going up with it. But this is not what I expect to be down the road, for the next 6 to 12 months. I believe we're going to see energy roll back over again. So what I just say about energy is it a lot of times seems to move to the beat of a different drummer. It's not always technicals. A lot of times you get things happening over in the Middle East that can send energy higher, lower, whatever. So keep an eye on energy. Just make sure you keep raising your stop. That's all. You can trade it. I'm not going to talk about it because that's not a group that I think is going to be a long-term leader. But if you believe it is, go for it. I'm not right 100% of the time, that's for sure. Technology, also decent day yesterday, rising about 0.25%. So, and when you look at communication services and technology being two of the top 3 spots, kind of easy to understand why the Nasdaq was the one area that held on to gains yesterday, because that area is dominated by those 2 sectors. So pretty good action yesterday, even though we didn't, we had much stronger action earlier in the day. We still had a pretty good session overall on the Nasdaq, finishing higher. So moving on to the industry groups, you can see the internet group rising more than 2% yesterday to kick off April with a breakout. Again, this is a group that really does like April. If we have time, maybe I'll show you that seasonality chart a little bit later. Renewable energy, also big move. I don't know if this is starting a bigger move or not. This is a group that I pointed out in our weekly market report, probably maybe 3, 4, 5 weeks ago, talking about, if we could continue to hold these lows. This is a really volatile group that many times will take huge moves to the upside, but it also can make huge moves to the downside. And if you look at the last several months, it's just been kind of consolidating, trying to figure out which way it wants to go. So we've had big moves to the downside, but we've also had big moves back to the upside. And we can't really quite figure out the clear winner here yet, whether it's bulls or bears. So we're getting close to what would be a pretty big breakout on the renewable energy stocks, though. And they've been beaten down for a long time. When this group moves, they tend to move like semiconductors. So you might look at it and say, wow, it's already made a big move. I couldn't possibly jump in. Well, when this group moves, think about what you might have been thinking about semiconductors a year ago. You miss that first move and you think, wow, it's all done. And then next thing you know, semiconductors doubles again over the next 6 months. That's the types of moves that you can see with renewable energy. So I like to keep an eye on the group. Just remember, if you're trading these names, these are really volatile stocks. So if you're trying to preserve capital and you're living off of income, dividends, stay away from renewable energy. That's not where you want to be. But if you're more aggressive and you're willing to take more risks, this is a group, again, when it gets going, it's a group you want to be in if you're an aggressive trader. Gold, kind of like energy. I'm not a fan. In fact, I'm less of a fan of gold than I am energy. Gold has its moments from time to time. We're seeing some weakness in the market. I expect the volatility index to pick up. The dollar has been kind of meandering in the short term. I think long term, the dollar's clearly in an uptrend. So I think gold's getting a lift from a couple different areas. Also, keep in mind, gold, when it broke out recently, it was breaking out of a 3-year sideways move. The S&P 500 was flying to the upside in 2020 through the end of 2021. We had the cyclical bear market, and then the S&P 500 went ripping to new highs again. So when I look at gold, I look at it relative to the S&P. If you want to look at it on an absolute basis, then it's breaking out. Looks great. But pull up a 30-year chart or 25-year chart on GLD SPY and just look at the relative strength of gold versus the S&P 500 over the last 25 years. The first half of those 25 years, gold outperformed, and it outperformed when the dollar was falling consistently. The last half of those 25 years, we've seen gold absolutely getting killed because the dollar is uptrending. So until that uptrend in the dollar ends, until I see a definitive move that shows a breakdown of the long-term uptrend in gold or in the dollar, I have no interest in gold. I mean, yeah, short term, you'll get a breakout. You'll get some moves from time to time. Just be careful. Rates here in the U.S. start going up because of the economy. It's going to strengthen the dollar even further. That is going to put a damper on gold's performance relative to the S&P 500. And I want to be clear about that. I don't want someone coming back later and saying, you said gold was going to go down. I think gold could go up. I just don't think it's going to go up as much as the S&P 500. And that's really what I'm interested in. I'm trying to outperform the S&P 500. So if gold continues to be an underperformer, like it's been for the last 12, 13 years, how are you going to outperform the S&P 500? It's going to make it tougher if you're taking a portion of your assets, putting it into gold. So, but again, like energy, it's rising right now. It's in an uptrend. Certainly stick with it if you're in it. I'm not interested. I'm not interested when it was beaten down. I'm certainly not chasing it. I'm staying away from both groups personally. All right, moving on. 10-year Treasury yield. Get a quick update here. 438.5. So we are down a little bit from the earlier high. I think if you want to see the stocks rally, you're probably going to need to see this reverse. Just because, again, short term, when rates go up, we tend to see, or when the yields are going up, that's when we tend to see the market weaken, especially small caps. Small caps have kind of been going up when the yields come down, down when the yields go up. We'll see how all of this plays out over time. I think that'll change. But again, this is a breakout. You can see it clearly. This is that cup I was referring to earlier. So here you're rising. You got a cup, and then you put a handle in back to the moving averages, and now you're breaking out. This measurement goes from the top of the cup to the bottom of the cup. So we're looking at 435 to about 404. That's 31 basis points. You break above 435, you look for another 31 basis points. That gets you up to 466. So that's what I was talking about earlier, 465 to 470. I could see in that area simply based on technical pattern. Now, I don't, again, if we have a strong jobs report this week, we have jobs coming up on Friday. That's going to be a big report. If it comes in hotter than expected, you might see another push up. Now, again, eventually, listen, we want our economy to strengthen. We just don't want it to strengthen and trigger more inflation problems. I don't think it will. I don't think inflation was, I don't think it was simply the higher demand that caused inflation. I think inflation in the first place started because of lack of supply, not heavy demand. I mean, we did get an increase in demand coming out of the shutdown. Don't get me wrong. We definitely did. But when you shut your factories down for a month, you're gonna certainly have a shortage in supplies. And that's what we ran into for a couple of years, with shortages everywhere. It wasn't so much demand was off the charts. Our GDP, did go up quite a bit after that first year because it was, it was at ground zero when you shut down the economy. So of course you're going to pick up. But I mean, our GDP is nothing massive. I think the last one for the last quarter came out 3.3% or something like that. That's good growth. It's not crazy growth. So I think we just have to watch and see how this evolves in terms of rates. But I think if rates, are in the fours, I would be okay with the rates in the fours all year on the 10-year Treasury yield, as long as that the Fed funds rate starts coming down later this year. Honestly, that's the spread starting to widen and widen and widen for banks. So if you think the banks have already made a pretty good move, they're likely to make an even bigger move down the road, or at least continue to make the move they're making. In other words, I think it's sustainable. So we'll see what happens with the 10-year Treasury yield, but at least for now, we're getting that breakout. S&P 500. So you can't see, I mean, you look at the chart. Okay, yesterday we had a little bit of a move to the downside. No big deal, right? You go into the 10-day, or excuse me, the 10-minute 5-day chart and look at all the selling up till noon. So we were up in the morning early in the first 20 minutes or so. The manufacturing report came out at 10 a.m. and you can kind of see selling that took off right there. And so that was right at around 10 a.m. And if you look at the 10-year Treasury yield yesterday, it got off to an early start, but look from about, this is 9 a.m. to, let's say, around 11, something like that, or 9 even to 12. And so that was where we saw the big rise in the 10-year Treasury yield in the morning till about noon. And that's when we saw the selling in the stock market in the morning till about noon. And then we started to rally back. So we're getting a big gap up in yields again today. So I'm not shocked. I mean, we can pull up and I can show you what's going on in the pre-market. But right now, the diamond's down 0.8%. Spider down 0.8%. QQQ down 1.12%. And the IWM down 1.17%. IWM, by the way, held on to a key support level at 208.21 yesterday. We're going to lose it at the open today. And we're going to get to the IWM in a minute. So I'll look at that in a second. Nasdaq 100, though, pretty much same thing. We did do a little bit better because the leadership we saw yesterday, communication services and technology, helped keep that afloat. We continue to trade above the 20-day moving average. I would have expected if we were going to see weakness, we would have seen it in the second half of March. Maybe we're going to get it at the beginning of April. It looks like we might lose that 20-day moving average with all these negative divergence that have just been piling up with every high. This could be a trip down to the 50-day moving average. Wouldn't be a shocker. It's what I really was kind of hoping we would have done in March, but we never did. So I would be watching First, obviously, the 20-day moving average. But if we gap below and rates are up, that is, that could be the recipe to see us go back down and test that 50-day moving average. We'll see. IWM, as I mentioned there, we had the shooting star, but we did make the breakout. I think we could go down, test that 20 and bounce off of it. But again, if we don't, what I'm watching, the big picture on the IWM is the weekly 20-week moving average right here, which is now up above or almost above 198, 197.72. That's where we're holding on the any more significant pullbacks. And this weekly chart, after showing nothing but sideways action, no trend whatsoever, is now showing an uptrend in play. And so when you have that 197, 198, that 20-week moving average, that is, in my opinion, the biggest number on the IWM chart. And I'm a fan of the IWM. I think we're going to go higher. But if we lose short-term support in the price, which it looks like we're going to, that's the 208.21. And then that 20-day moving average, which is currently at 205.12. And I think we just said the IWM 205.89. So it looks like we're going to gap down close to that 20-day. And let's see if we bounce off of it. That's going to be our first clue as to whether or not this is just a temporary move down right back to the upside, or is it going to be something maybe a little bit more significant? It would be odd, not that it's impossible, but it would be odd to do it in the first week of April, which does tend to be very bullish historically. So kind of up in the air. This is what we've been dealing with really for the last 30 days. I mean, the rotation away from growth into value, or aggressive into defensive. We've seen this for the last 30 days, and that's kind of put a little bit of a lid on the market. We've been going up slightly. Nasdaq maybe not as much. So we've been struggling, but I believe we're going to probably have another big move to the upside, and I think it's going to come with earnings, which starts in just about 2 weeks. All right, transportation stocks. Okay, so here was the move up. We pulled back, stayed above the moving averages, and went to a new high. I was ready. I wanted to see this breakout on the transports. Did not happen yesterday. Came back down. Here's what we want to watch on the transports. These moving averages and the recent price low all come together between 15.8 and probably 15, the 20 days at 15.863. So somewhere between about 15.8, 15.863. That's where we want to watch, because if we move right back down below these moving averages, then we're right back into this sideways trendless action that we've seen throughout 2024. If we hold it, though, and can move back and break out, that would be very, very bullish. So which way are we going to go? That's the chart I'll be watching. Let's move on to the chart of the day. So if you want to find my home, it's over at earningsbeats.com. Make sure you start your 30-day no-cost trial. It will include 4 educational events that are coming up: Candlesticks, price volume, divergences, trading gaps. Candlesticks we actually did last night, but we have the recording available. So anybody who's joining can get the recording, and which will actually, I think it's being sent out this morning, but you'll be able to access that on our website. Next Monday, we're doing another webinar, price volume. The following Monday, divergences, that's the 15th. And then on the 22nd, trading gaps. I'm going to show you, this is probably, well, it's definitely more than 50% of my trades falls into this category: trading gaps, trading earnings, which usually results from gaps. So this is going to be a big one where I talk a lot about how I trade. And this one's going to be on Monday, April 22nd. So anyway, 30-day no-cost trial gets you everything, gets you all of these. So make sure you click on that, get registered for those upcoming events. If you just want to learn a little bit more about earnings beats, you're just kind of dipping your toes in the water here, we have a free newsletter. No credit card required. You can unsubscribe anytime. It's simply what I like to refer to as our community of like-minded traders. I believe a lot of times in the research that I do that it is an us against Wall Street kind of a mentality. That's kind of mentality I take. Wall Street, I think, does everything that it can to pull the wool over our eyes. They make their money by taking advantage of you and me, retail traders. And so this is the first step, I think, in just kind of joining a community, I should say, a community of like-minded traders who are trying to, you know, fulfill all your financial goals and dreams and so forth. But if you're going to get there, you better learn a lot more about what Wall Street does. And this will help get you started. Name and email address. We'd love to have you. All right. So chart of the day. What I wanted to show you today, actually, let's just jump into Google because I mentioned it earlier. So for the chart of the day, I wanted to show you volume picked up yesterday and we made a breakout. So even though they were selling the second half of the day yesterday, that was not the case with Google. So if we pull up, we went up very early in the day and we held on to those gains all day. Didn't see really any deterioration. And then at the close, more strength. So I was kind of watching this to see if it was going to be an intraday breakout and then a false breakout where we would actually close back down, below this high. But we didn't. We actually closed above it. So we did make the breakout. You can see the AD line starting to turn back up. And even during the period while Google was, falling pretty rapidly from 154 to 130. I mean, if you look at where we were here and then where we were when we were at 130 on the AD line, we're almost flat. So what does that tell us? I mean, without even looking, it tells me that probably most of the weakness was in the morning and it was followed by some decent afternoon action. So we weren't closing on lows very often. We did here and we did here and maybe this one red candle here. But for the most part, we were bouncing off. I mean, look at a lot of these days when we were down, but we were way off the low, closing near the high of the day. That drives the AD line higher. I mean, I know a lot of folks just look at it and say, well, it's down. Well, down isn't, not all downs are equal. A stock that goes down and sells off all day long and finishes on the low, that finishes down 4%, to me, is not the same as a stock that maybe goes down 8% intraday and rallies back near the high of the day and finishes down 4%. Both stocks finish down 4%, but one of them looks like a lot of distribution to me, and the other one looks like a lot of accumulation to me. They are not the same. And that's one big difference between the AD line and on balance volume, OBV. I am not a fan of OBV. I think when you use these two together and they confirm one another, that's fine. But if they go in opposite directions, I'm using the AD line every time. Because in that example I gave you, where you go down 8% intraday, but then rally back and finish near the high of the day, still down 4%, that's sending the AD line up. But anytime you finish down, I don't care how you could be down 20% at the opening bell, and you could rally all the way back and finish down a penny on that stock. All that volume is subtracted in the OBV. You had buying all day long to the tune of 20%. And it's treated as though all that volume is negative in the OBV. Makes no sense to me. I follow signals that make sense. So AD line versus OBV, that's one of the big differences. And that's why you always see the AD line on my charts. When I am featuring one of the two, you never see me put the OBV on my chart. I just don't believe in it. I think the AD line, much more visual, much more powerful to give you an idea of what's really taking place in a stock. So I stick with the AD line. All right, we got one more minute here. What do we want to talk about? How about yesterday in the candlestick session that I did? I had a couple questions coming in about how to scan for candlesticks. And if you go over to Chart School, you can, in the search box, how do I scan for hammers? How do I scan whatever? And you can get some information in Chart School about it. But one thing you can do without having to go to Chart School, making it much easier, is if you come down here under your scans, I always want to make sure if you go down, you don't see your scans, that's probably because you haven't checked this box. So hit this gear shift over here on the upper right-hand corner and make sure that scans and alerts is checked. If it's not, and you go down, well, let's try that. Oh, I probably didn't save it. All right. So then if it's not, you go down, you're not going to see your scans. If you don't see it, click on that. Make sure that scans and alerts are saved. And then when you go down, you will see scans. Anyway, over here on this more button, if you click on that, you have a drop down. One of the choices is predefined scans. Click on predefined scans. Scroll down and you'll see candlestick patterns. So if you want to take a look and see how many stocks formed, bearish engulfing yesterday, 511. They break it down by index. So if you wanted to look at the bearish engulfing on the Nasdaq, just the Nasdaq stocks, actually we must have opened. So this is going to be today's. So too late to do it. That was yesterday. I was getting ready to show you. It's now 9:30. So apparently right now we have 2 stocks that have already put in a bearish engulfing. So those must be interesting charts. But anyway, that's a great place to go to find certain things, dojis, hammers, shooting stars. I showed you that shooting star on the IWM, and we reversed off of it. Filled black candles, hollow candles, all these things we talked about last night, or most of these we talked about last night in our candlestick event. So again, if you go over to Earnings Beats and you subscribe, become a 30-day trial member, you'll be able to go in, check out that recording from last night. I couldn't imagine trading without candlesticks. Personally, I love candlesticks. But anyway, that's it. So let's take a quick look what's going on in the market. And wow, Dow down 387 to get started. S&P down 43. Nasdaq down 196. Small caps down 16. So everything down somewhere just beneath 1% or maybe just above 1%. We got the VIX right now. I thought the VIX, okay, it's showing up 7.77%. Let's see if that's the real deal. Yep, 7.77%. So we are rising. Probably, you have to understand, short-term bottoms in the stock market occur with short-term tops in the VIX. So if you go back and you look at these spikes, that's where you're going to see the lows so far in 2024. Now the VIX is spiking. Interest rates have broken out. I think you got to be a little bit careful here in the near term. I probably wouldn't be adding anything right now. And maybe even if you're getting stopped out, take the stop out. Let's see how far this VIX goes up. My guess, I said earlier this year that I thought the VIX throughout the year probably, at least until late summer, probably wouldn't see much above 17 or 18, 20 being like an outside chance, but probably not. I'm thinking 17, 18. Here we got up to 18 back in the second week of February. Right now we're getting close to 15. I mean, this could escalate for a couple of days. Kind of hoping that it's just morning weakness and we rebound, go right back above some key support levels. But if it doesn't, and we see weakness and we see the yields keep going up, prices going down today, that VIX could easily jump into that 16, 17, 18 range. And as you get closer and closer to that range, I would start looking for short-term bottoms in the market. Anyway, that's it for me. Everybody have a great rest of your day. I'll be back tomorrow on Wednesday for your next Trading Places Live. So make sure you check back in. If you like the work we do, make sure you hit the like button and subscribe to our channel so you don't miss any upcoming episodes. Everybody have a great day. Happy trading.